Okay, good evening, everyone. Welcome to Financial Reporting Revision Session for Skills for the forthcoming Ican November 2021 Diet Examination. Okay, today we'll further look at another examination question, which was a compulsory question in the November 2020 diets. Okay, and we'll be looking at this question, and we'll try to do it all together. We'll try to solve it together, ask questions where it is needed, and I believe at the end of the day, we will have put justice to what we need to do. And this might be the final revision for group. Any other revision might be other aspects, especially with respect to financial instruments and probably income taxes or any other areas to which I've covered. Okay, now I want someone to volunteer to read the question. Somebody will volunteer to read the question. The first person that will volunteer will read the question. That is from the aspect of the financial statements. And the second person will read the additional information up to the level of requirements. I want two people to volunteer. I think the first person that volunteer with a show of hands is somebody with Galaxy A02s. Who is the second person so that I can give access to you? Who is the second person? Okay, Solomon Friday is the second person. Okay, Galaxy A02, I'll give you access to a mute and you can read the question from that perspective. Okay, over to you.
Good evening.
Good evening.
The financial statement of Orobo, Lepa, and Opeki as at December 31st, 2018 are as follows. Statement of financial position. We have the non-current liability, the current assets, equity and liability, and also the non-current liability. The next slide, sir.
Okay, what I wanted you to focus on is to read those items without calling the figures. Those items that make up each grouping of asset, liabilities, and equity.
Okay, sir. Non-current assets, freehold property, plants and equipment, investment. We have the current assets, under it inventory, trade receivable, bank and cash, and we have the total assets. We have equity and liability. Under the equity, ordinary share capital at ₦1 each, retained earnings. Under the non-current liabilities, we have the 12% loan notes, and under the current liability, we have the trade payable, bank overdraft, and we have the total equity and liabilities.
Okay. Now, Solomon Friday will read the additional information. Over to you.
Good evening, sir. Good evening, everyone. Okay. Additional information. Orobo PLC acquired 15 million ordinary shares in Lepa Limited in January 2013 for 25 million, when the retained earnings of Lepa Limited were 5 million. At the date of acquisition of Lepa Limited, the fair value of its freehold property was considered to be 10 million naira greater than its value in Lepa Limited's statement of financial position. Lepa Limited had acquired the property in January 2013, and the building element comprising of 50% of the total value is depreciated on cost over 40 years. Orobo PLC acquired 5.625 million ordinary shares in Okpeke Limited on January 1st, 2017 for 12.5 million naira, when the retained earnings of Okpeke Limited were 3.75 million. Lekpa Limited, that is IV, Lekpa Limited manufactures components used by both Orobo PLC and Okpeke Limited. Transfers were made by Lekpa Limited at cost plus 25%. Orobo PLC held 2.5 million naira inventory of these components at December 31st, 2018. In the same period, Orobo PLC sold goods to Okpeke Limited, of which Okpeke Limited had 2 million naira in inventory as at December 31st, 2018. Orobo PLC had marked these goods up by 25%. V. The goodwill of Lekpa Limited is impaired and should be fully written off. An impairment loss of 2.3 million naira is to be recognized on the investment in Okpeke Limited. VI. Non-controlling interest is valued at full fair value. Lekpa Limited shares were trading at 1.60 kobo, 1.60 naira just prior to the acquisition by Orobo PLC. Required, prepare the consolidated statement of financial position of Orobo Group for the year ended December 31st, 2018. B. Ikoko PLC started business 3 years ago following a research breakthrough that motivated large-scale customers to order the company's new product. Extracts from the financial statements recently published are as follows. Statement of profit or loss for the year ended December 31st, 2014. Details of the statement of profit or loss. Revenue, cost of sales, gross profit, operating expenses, operating profit, interest expense, tax expense, profit for the year. Statement of financial position as of December 31st, 2014.
I think you need to stop there. That speaks to another question. Our focus is on the group aspect, which carries 25 marks. Thank you very much. I think Solomon Friday. Thank you very much. Now let's pick it one by one. Let's go back to the information. Apart from the balance sheet, the first information given to us is Orobo acquired 15 million shares in Lekpa. Okay, and let me cut that and paste somewhere here so that we can always make reference to it. Okay, I switch my screen to the whiteboard. Now, I've cut this and we analyze it. Orobo acquired 15 million shares in Lekpa Limited in January 2013 for 25 million naira. Okay, now let's try to determine the percentage of this. They acquired 15 million shares out of how many shares? If we go back to the question, how many shares? Now we are not giving the number of shares, but we are giving the share capital of Lekpa All figures in 1,000, 25,000 in 1,000 means 25 million naira ordinary share capital. And we need to convert it to shares. And we have how many shares here? Or we have nominal price to be 1 naira per share. Therefore, we'll come back and say, we have information that the share capital let me put that somewhere here. Number of shares of LEPA is a function of the share capital divided by the nominal price. And the share capital is set to be 25 million naira. And the nominal price is 1 naira. Therefore, that is 25 million shares. That is how we arrive at that. Now, if that is the case, what is the stake we have? We have 15 million out of 25 million shares. What percentage is that? Let me put it on my own Excel. 15 million shares out of 25 million. What percentage is that? 15 divided by 25 in percentage. That gives me 60%. Okay. Now, secondly, we also have information. We'll go back to our question. We have information, which is information that Orobo equally acquire shares in another company. Okay. Now, Orobo acquire 5.625 million shares in Opeke on 1st of January 2017. Now, again, what is the percentage holdings? Is 5.625 million out of how many? We'll go back to our question. Our share capital is 18,750 and at 1 naira each. Therefore, we go back there, 18,750 at 1 naira each, which means I can do it simultaneously. Let me just do it by the side and use different color so I don't waste my time. Now, to do it for Opeke, this Opeke, the share capital is 18.75 million divided by 1 naira will give me 18.75 million shares, which means I have 18.75 million shares. What is that percentage? I go back to my own Excel. You are using calculator. 5.625 divided by 18.75. What percentage is that? 30% is what it gives me. 30%. Now, this aspect is LEPA, this aspect is OPK. That is that. Now, let's look at it without any other information to the contrary. Or about having 60% stake in LEPA means there is control. Therefore, LEPA becoming the subsidiary of Orobo and Orobo becoming the parent of LEPA. Whereas between Orobo and Opeke, what exists is significant influence. Thereby, Opeke becoming the associate of Orobo. On that premise, we can only consolidate LEPA and account for equity stake in Orobo. In that case, we also take opportunity to do this. The reserve have to be split into pre and post. Split or splitting of retained earnings as at the reporting date, 31st December 2018. I have LEPA and I have Opeke, all figures in thousands of naira. I have my pre-acquisition reserves and I have my post-acquisition profits or loss. Now let's go back to our question. When LEPA was acquired, the retained earnings was 25 million positive. No, sorry. Okay, the value it was acquired was 25 million. When the retained earnings of LEPA were 5 million. Okay, which means to come here to say the pre-acquisition is positive 5 million. Why at the time Orobo was acquired, the retained earnings positive reserve was 3.75 million. Now we go back to the balance sheet. In our balance sheet, what was the reserve as at today? As at reporting date, LEPA is 22,125 million, and Opeke is 9750. Therefore, I switch back to say this is plus 22,125, and this is plus 9,750. Therefore, what is my post-acquisition profit? The difference here, if I'm not wrong, is about 17,125, and here is about 6 million. You can correct me. Also, you can be putting your own figure in the chat for those that are using calculator. Okay. That is that. If there's any question, kindly show your hand or ask question where it's needed. Now we've dealt with some elements of information 1 and information 2. What are left out are the investments. The cost of the investment in LEPA is 25, while in Opeke is 12.5 million. Okay, we'll take note of this. No question yet. Now let's look at other information that might be necessary. I go back to my question. Information 2. Let me extract it out and see what happens. I bring it to my whiteboard. Now, we're told that at the date of acquisition of LEPA, the fair value of his freehold property was considered to be 10 million naira greater than the value in his financial statements. Now, in this case, what they are saying is that when they fair value the property alongside with other assets and liabilities, it's only freehold property that have fair value different from the carrying amount. And it's different by having 10 million naira in excess of what the carrying amount is, which means if the carrying amount was 20 million, the fair value was 30 million. That's what it means. And it then means that the fair value adjustment let me use a different pen. The fair value, let me clean it. The fair value adjustment at acquisition date was a fair value gain on the measurement of freehold property. And what will that create? It will create increase in the group property, plant, and equipment. And that will create increase in the pre-acquisition retained earnings or reserves, as the case may be. With how much? With 10 million naira. Which means in measurement of goodwill, there will be an impact. And subsequently, there will be depreciation effects, given that the property has a component of it, which is a building element, that will have been subjected to depreciation. Why the non-building component or element, which is a land, which represents about 50% of the value, will not have been subjected to depreciation. Therefore, there won't be adjustment on that, but there will be adjustment on the building elements. And they've given us that the building element comprises 50% of the value, which means it's 50-50. 50% is land, 50% is building, which means this 10 million also, the valuation component of it, 55 million relates to building, 5 million relates to land. And that means that it's a 5 million that will have a depreciation adjustment on, because the land will not have been subjected to depreciation, which will not have required an adjustment for excess or under depreciation, as the case may be. Now, in that case, what will be the subsequent effects of this? We're told that LEPA had acquired the property, which means the subsidiary itself acquired the property at the same time the subsidiary was acquired by the parent. If you recall, the date of acquisition of LEPA was in that same January 2013, which means the assets has never been pre-used by LEPA before its acquisition. And since the acquisition to date, if you do your count from January 2013 to 31st December 2018, that is exactly 6 years the asset has been put to use post-acquisition. Which then means that the asset, the building element of it will have been depreciated for 6 years. And the depreciation on it would have been based on the carrying amount and not at the fair value. Therefore, it means since the fair value is higher, the asset will have been under depreciated. And therefore, we need to determine to what extent has the asset been under depreciated, and will now pass the relevant adjustments. Now to do that, I come here. The fair value adjustment has two components: land component and building component. And we are told it's 50-50. Which then means that this adjustment of 10 million, positive adjustment because it's upward, we have 5 million for land and 5 million for building. Recall, land is non-depreciable, whereas building is depreciable. Therefore, our adjustments will only be restricted to this. Which then means that our additional depreciation adjustments which is for 6 years. Remember, January 2013 to December 2018 is 6 years. It's quite different if we have acquired it at December 2013. It will have been 5 years. Please, you can do your hand count. Now, therefore, 6-year depreciation adjustments means that the 5 million, which is for the building, you call building, will be depreciated over how many years? We were told that the useful life of the asset is 40. Therefore, it will be 5 million depreciated over 40 years. On average, let me use my example, 5 million over 40 years. What is that? That means 125,000. The depreciation per year that has not been captured or has been under depreciated. And this has gone for how many years since we are dealing with the balance sheet? 6 years. Therefore, 6 years times 125. Give me 750,000 naira. That is the total amount of shortfall in depreciation that has been charged. And since this depreciation will have affected the subsidiary's profits, therefore it means the parents and the NCR, who are the shareholders in the subsidiary, will be affected. Therefore, what entry do you pass? Since it affects the subsidiary's profits, which is a reduction because you are charging more depreciation, invariably 60% affect the parent, which goes to group reserve or consolidated reserves, and 40% affects NCI, and the corresponding credits is a reduction in group PPE. How much? 750. Now, what is 40% and 60%? 40% is NCI, 60% is the parent. Therefore, NCI will take 40% of 750, that is 300, and parent will take 60% of 750, that is 450. Therefore, 450, 300. Okay. There's no depreciation adjustment on the land. Let me emphasize it here. No depreciation adjustment on land because it is not depreciable. Let's take note of that. Okay. I think we've dealt with the whole of information 2. Now let's go back to the question and see which information again do we need to emphasize. Okay, information 5 says the goodwill of LEPA is impaired and should be fully written off, which means any amount of goodwill by now should have been fully written off. That means we need to determine that first. And we also told that investment in Opeke has suffered impairment loss of 2.3 million. We'll take note of that also. Now, what is also key is that NCI is measured at full fair value. And LEPA's share price was traded at 160 kobo just prior to the acquisition by Orobo, which means the accounting policy, I'll take note of that. Let me copy that and switch to my whiteboard. Now, NCI is to be measured at fair value. Now, NCI at fair what? Value at acquisition dates, which means the value is the number of shares multiplied by the market price per share. Now, what's the number of shares? Remember, it has 40% stake, which means out of 25 million, it's entitled to, it has 10 million because 15 million belongs to the parent. Therefore, I'll come here and say, out of 25 million, 15 million goes to the parent, which means what is left is the NCI, which is 10 million, multiplied by 1.60 kobo per share. And that gives me 16 million naira, if I'm not mistaken. Any question? Okay. Now let me put up my group structure as our tradition, even though we didn't start with that. But as tradition, let me put up my group structure. How many members do we have in this group? It's still 2. Opeke is not a member of the group because it's not a subsidiary. Therefore, we have Orobo. And we have Lepa. What stake? 60%. NCI, 40%. The date of acquisition was 1st of January, 2013. And the date of consolidation is 31st December, 2018. And this is 6 years. Okay, now let us carry out our cancellation and determine any amount of goodwill. Goodwill, if any. All figures in thousand. Cost of business combinations. Robust investments in LEPA and the amount of NCI in LEPA. Now let's go back to the balance sheet. Investments. Total investment is 37.5 million, which is broken down into 25 million and 12.5 million. Now, let me check. 25 million plus 12.5 million, what does it give me? It gives me 37.5 million, which is exactly what is here. But imagine what is here is not at 7.5 million, but is 40 million. Who can tell me what has happened and how will you have treated that difference? Who can tell me that? If this 37 million had been 40 million, such that when we added 25 and 12.5, it's 37.5, but what we have as investments here is 40 million. What will you have considered the difference to be? What has happened? Who will give us a guidance before I answer that question? I need one, at least one hand raised up. I have not seen any hands. Okay, Solomon.
Okay, if we
Solomon, over to
you. Okay, sir. If we discover that the investment was, yes, sir. Can you hear me, sir? If we discover that the investments in the Orobo statement of financial position was not equal or was more than what we saw in the acquisition of Lepa and Opeke, that means there would have been a goodwill recognition in the books of Orobo.
Goodwill, how? Goodwill only emanates from the investment you might have in Lepa, which is 25 million. Therefore, I don't think that is right. Abbas.
Sir, good evening, sir.
Good evening.
Good evening, sir. Sir, if we find out that the investment is more than what we saw in the note, that means that there is another investment in associate, which means that our body not have significant influence. It's just an ordinary investment.
No, I think you are missing it all. Okay, let me assist you. What it simply means is that since 25 million was invested in LEPA, 12.5 million was invested in Okweke, which make up that 7.5 million. But what we have in the balance sheet of Orobo is 40 million. The difference, which is 2.5 million, represents other form of equity investments that Orobo may have outside that of LEPA and Okweke, which means that he has other investment that neither qualify as having control nor qualify as having a form of significant influence or even joint control, but rather a simple investment which can qualify as a financial asset investment, which means you treat that as other investments and you reflect that in your balance sheet. Thank you guys for your contributions, but in this case, it's the same amount and therefore there is no cost for alarm. I turn to my notes. Investment in LEPA is 25 million. If you remember, where's 25 million coming from? It's coming from the first information here, 25 million. And what is NCI measured? It's measured at 16 million. Therefore, we'll come here and say 25 and 16 will give me 41. I'll compare that with the fair value of the identifiable net assets of LEPA as at the date of acquisition. And that is share capital and pre-acquisition retained earnings. These are the first item. And if we go back to our balance sheets, what is that? In my balance sheet, the share capital is 25 million. Why the pre-acquisition reserve is as computed earlier in the day. This 25 million. And the pre-acquisition retained earnings, remember we computed it here to be 17,125. 17,125. And remember, we have adjustments for the fair value, adjustments on freehold property. And I think that was 10 million, both the land and the building. Land and what? Building, 10 million. Therefore, I'll come here, I'll say plus 10. Okay. Now, I need to sum it up. Okay. Now, I think we pick a wrong figure here. The pre-acquisition is not 17.5, it's a post-acquisition. The pre-acquisition is plus 5 million. Sorry. Plus 5 million. And that gives me plus 15. Plus 15 plus 25 will give me 40. All things being equal, what is my full goodwill? My full goodwill is 1,000 or 1 million. Now, but don't forget an information somewhere here. Let's go back to the question. I think note 5. Note 5 says something about goodwill. Let me copy it and bring it down somewhere here. It says the goodwill of LEPA Limited is impaired and should be fully written off. Let's deal with that first. The goodwill said should be fully written off. Therefore, what does that mean? It means that goodwill of, let me use red since I want to write it off. Goodwill of 1 million naira should be fully written off as thus. Therefore, we charge it to subsidize profits. And since it's a full goodwill, the impact is such that it affects both the parent, 60% parent, and 40% NCI. Let me write it clearly. And the corresponding credit is to fully write off the goodwill. 1 million. Now, this goes to the consolidated reserve. The other one goes to NCI. That's 600,000. And the 40%, 400,000. Okay, which means the corresponding credit is to come here to write off the impairment loss, 1 million, which means no goodwill to be consolidated. Consolidated goodwill is nil, based on the fact that it has been totally written off. That's what it means. Okay, somebody said we can't see the screen. Thank you for notifying me. Okay. What we said is this: the full goodwill of 1 million, we are told it has been fully written off. The goodwill of LEPA Limited is impaired and should be fully written off. And we said to write it off means goodwill of 1 million should be fully written off as thus. We charge that loss, 1 million, to the subsidiary's profits. But the subsidiary profit, as it's affected, ultimately affect the shareholders, which is the parent and NCI. Secondly, because this goodwill that was impaired is a full goodwill, That is goodwill that recognizes the contribution of the parent and NCI. Therefore, the loss will have to be borne by both the parent and NCI in the proportion they share profit or loss. That's why the 1 million invariably affect the parent through consolidated reserve by 600,000 and affect NCI by 400,000. And the entire goodwill of 1 million is written off. That's why we are crediting the goodwill. And the impact is that what we have derived from this account here that shows full goodwill of 1 million was later written off in full, such that our consolidated goodwill as at the end of the year was 0. And in this case, we have no goodwill to report in our consolidated statement of financial position. Okay, that is that. Now let's go back to additional information, whether there's any other information again. We've dealt with information 1 in full. We've dealt with information 2 in full. We've dealt with information 3 in full, subject to determining the equity investment, which is the only thing outstanding. Now we have information here, which is critical, information 4. Let me copy it and let's deal with it. Okay, now LEPA manufactures components used by Orobo and Okweke Limited. Transfers were made by LEPA at cost plus profit, which means there's a markup of 25%. Orobo PLC had 25 million inventory of this component as at the end of the year, which means the unsold inventory is 2.5 million, of which there's a profit element in it by way of markup of 25%. Now, this 2.5 million is the value, or what? But they gave us markup. Therefore, we need to convert markup to margin. This is markup. We have to convert to margin. That's number 1. 2, again, in the same period, in 2018, Orobo sold goods to Okweke, the associates, and 2 million of these goods were held in inventory of associates. And also when Orobo sells, it sells at a markup. It sells at a markup of 25%, which means this one too is markup, which have to be converted to margin, because the 2 million is not the cost to Orobo who sold, but is what is the value. Therefore, what will I do? I need to determine it one by one. Let's start with the relationship between the parents and LEPA, the subsidiary. LEPA which is the subsidiary, sold to Orobo, which is the parent. We characterize this as an upstream transaction. If that is the case, my unrealized profit is the unsold goods, which is based on value times what? The margin. Because it's not cost they gave me value. Therefore, what I'll do is that since I have a markup of 25%, what will I do? I will convert to margin. That is, markup is profit over cost, assuming P stands for profit and C stands for cost. Is 25%. 25% is 25 over 100. P is 25, C is 100. To convert to margin, you recall that margin is profit over selling price. And selling price is cost plus what? Profits. Therefore, I can substitute my equation and say P stands for profit, C stands for cost, and P stands for profit. I can then substitute 25 for P, substitute 100 for C, and 25 for P. I have 25 over 125. And therefore, this is my margin. If I like, I can put it to percentages, or I can leave it like this. In order to limit rounding error, it's better you leave it in that manner. And therefore, unsold goods is the value of inventory, which was 2.5 million. Times 25 over 125. And how much is that? 2.5 million. $2.5 million times 25 divided by 125. That gave me 500,000. That gave me 500,000. And since the transaction was done by LEPA, it means the profit is seated in LEPA. Since the profit is seated in LEPA, I have to take the profit out of LEPA, which is the subsidiary. Therefore, I debit the subsidiary's profit. And that ultimately will affect the parent, 60%, and 40% will affect the NCI. And this will impact consolidated reserve. What is that? And the credits will be to group inventory, which is 500,000. Now 500,000, 60% of it is 300,000. 40% of it is 200,000. 300 and what? 200. That answered that question. Now let's now look at also transaction between Orobo and the associates. That's Okweke. In the same period, Orobo sold goods to Okweke for 2 million at a markup of 25. Therefore, I come here, I identify that transaction. Orobo, the investor, sold goods to Okweke, the associate. We'll characterize this as a downstream transaction. Therefore, the unrealized profits is the unsold goods times the margin. Luckily, the markup was also 25% because the unsold goods, they gave us the value. And therefore, we have already converted 25%. Therefore, I'll just come here and say the 2 million, which is the value of the unsold goods times margin, which is 25 over 125. Therefore, 2 million $2 million is 400,000. But there's a question mark there. Because Orobo does not control associates, therefore, is unrealized profits, which is keynote, is unrealized profits in an associate or joint venture by an investor is restricted to its stake. In this case, 30% stake. I think I just 31. %30 stake in the investee entity, which is Okweke. Therefore, the unrealized profits to an investor in associates will now be restricted to 30% stake because he has no business with the other 70%. Therefore, anything he has sold to the extent of that 70% will have been considered realized. It's only the portion that relates to itself is unrealized, and that is 120 million. Or 120,000, sorry. And since who sold is Orobo, we are taking the profit back from Orobo, which is the parent. And since any attempt to selling the inventory of an associate will be an effort in futility because we can't consolidate the asset or liabilities of an associate. Therefore, such adjustment will be routed through our investments in associates. And that is how we route that adjustment, 120 million. And that's how we're able to treat the two adjustments, one between the subsidiary and the parents, and one between the investor and the associates. Okay, any question? If there's no question, let's go back to our question and see whether there's anything left out. We've dealt with information 1 in full, information 2 in full, information 3 to some extent because we are yet to determine the equity value of the investment in our associates. But information 4 has been dealt with in full. Information 5 have been dealt with partially to the extent of the impairment loss on goodwill in LEPA, but yet to account for investment loss or impairment loss on investment in OPEKE, which is the associates. Information 6 has been dealt with in full. Therefore, we will now treat partially information 3 and information 5. But we'll treat the 5 first because it's going to serve as an input to information 3. Therefore, we'll come down here. Impairment loss. On investments in an associate. OPEKE is to reduce that investment and the loss charged to the profit of the investor, which is a parent. How much is the loss? 2.3 million. Okay, that's how we have recognized the loss and we'll see that effect in the account. Now let's now determine the equity investment. In OPEKE, which is the associates. I'll figure in thousand. We start with the cost of investment. If you remember, the cost of investment as separately identified at the start was 12.5 million. This is it here. And we'll start to take share of post-acquisition profits, which is 30%. 30% of what? Let's go back to our post-acquisition profits. The post-acquisition profits of OPEKE was 6 million. And with 30% goes to the investor. 30% of 6 million. That should be 1.8, 6 million, 30%. 1.8 million. Now, there were adjustments. The first one was impairment loss, which we said is 2.3 million. We said we should deduct it. The second one was unrealized profits on Okweke's inventory. And that is 120. All things being equal, what is left? Is 12.5 plus 1.8 minus 2.3 minus 120. That should give that should give 11,880, if I'm not mistaken. Okay, that means we've dealt with it all in all. Any question at this point? If not, let us now look at our consolidated reserve and NCI. And from there, we'll move to our balance sheets. Consolidated retained earnings and NCI as at 31 December 2018. Retained earnings, NCI, all figures in thousands of naira. We start with Orobo, retained earnings, and the value of NCI as at acquisition date. Orobo retained earnings, we'll go back to our question. In the question, the retained earnings of Orobo is 36.5 million. $36.5 million, and the NCI as of reporting date, which we measured earlier, was 16 million. Therefore, come here, 16 million. Now, what is common is a share of post-acquisition profits of A, Lepa, and B, Okweke. Now, Lepa, we have ratio 60/40 of 17,125. And we have 30 of 6 million. We have 60/40 of 17,125. And we have 30% of 6 million. Okay. 17,125. %40 and 60%. %40 is 6,850. 60% is 10,275. 10,275. 6,850. And 30% of 6 million is 1.8. NCI is not affected with the associates. Now let's now pick adjustments. Adjustments. The first adjustment, let's go to the first stop. The first adjustment is unrealized profit. Additional depreciation adjustment on the freehold property. There's 450 and there's 300. 450 affect the parents. Which is additional charge, and 300 affects the NCI. That is additional depreciation, freehold property. What's the second adjustment? The second adjustment is impairment loss on goodwill. 600 affect the parent, 400 affect the NCI. Impairment loss on goodwill. Remember, it is full goodwill. 600 and 400. If it's a partial goodwill, it will only have affected the parent. Okay. The third adjustment is unrealized profits of LEPA to Orobo. Because it affects the subsidiary, it affects both the parent and NCI, 300 and 200. 300 and 200. Unrealized profit on inventory, LEPA and Orobo. The fourth one is unrealized profits on inventory between Orobo and Okweke. And that has no NCI impact because NCI is not a party, and that is 120 debit to good profits. No other adjustments. Okay, there's adjustment in payment loss on associate investments. Impairment loss on associates, 2.3. NCI has no business in an associate. Any other one? Since we followed it logically and systematic, no other adjustment, all things being equal. Sorry, I think all figures are in thousands. I think I've made a mistake here. Since all figures are in thousands, I have to do the needful. All figures are in thousands. Okay, since all figures are in thousands, what should I do? I should sum all this up. Please, you two can do that from your end. I'll try and use my Excel. 36,500, 10,275, 18 minus 450 minus 600 minus 300 minus 120 minus 300. All in all, this should give me 44,805. Please, I want you guys to also check. SCI, I have 16,000. I have 6,850 minus 300 minus 400 minus 200. That gave me 21,950. Please, I want one or two persons to confirm before I proceed whether it's correct. That is the summation I did. Have I seen any confirmation? Okay, Tolu said is correct. Okay, Abusai said is correct. Thank you, guys. Okay, now our balance sheet. Robo Group. Consolidated statement of financial position as at 31st December 2018. All figures in thousand. The assets is first grouped into non-current. And the items I have there are freehold properties. The parent is 48,750. The subsidiary is 31,250. Okay, you won't add the associates because you don't consolidate. Therefore, what adjustment affects the freehold property? The first adjustment was that there was an increase in the PPE, which means we'll add 10 million, and there was a decrease attributable to depreciation, which is 750. Therefore, I'll add 10 million and deduct 750,000. It means plus 10,000. plus 10,000 minus 750. And that gives me, you can check, 89,250. Next, plant and equipment. Plants and equipment. I have 19,875 and I have 9,375. When I add it together, there's no adjustments. That gives me 29,250. Investment. Investment left out is investment in Okweke, which is an associate, and it has been equity accounted for. If you remember the equity method of accounting, and what we had there was 11,880. Goodwill. We had originally 1 million, but it became nil because of impairment. Therefore, you need not show it. But I decided to show it just for your understanding. When you sum it up, you have 130 from Excel 380. Current assets. We have inventory. Then we have parents, 14,375. We have subsidiary, 75. Associate is not considered. There's an adjustment for inventory of the group, which relates to the unsold goods by Orobo as purchased from Lekpa, which is minus 500. When you deduct 500 from here, what do you have? You have 21,375. Trade receivable. You have 8,250 for parents, and you have 7,250 for subsidiary. That sum up to 15,500. We have bank and cash. $1,250 for parents, and subsidiary is 3,000, and that gives you 4,250. No other items. Therefore, by the time you sum it up, it gives you 41,125. $125, if I'm correct. What's my total assets? $171,505. Okay, equity and liability side. Equity and liability. Equity comprises share capital and reserves. Share capital will be for Orobo only, Arable is 50,000. Consolidated retained earnings. How much was it? 44,805. 44,805. When you add it, you have equity attributable to arable shareholders, and that is 94,805. Non-controlling interest. Again, we go up. Non-controlling interest is 21,950. 21,950. When you sum that up, you have your total equity, which is 116,755. Okay, non-current liabilities. I have 12% loan notes. I have 12.5 and 2.5. That should give me 15. That's 15. No adjustments. Current liabilities. I have trade payables. No adjustments. 17,000 the parent and 8,750 the subsidiary. That sum up to 25,750. Our bank overdraft. Only for the parents, nothing for subsidiary, 14,000. And when I sum it up, that should give me 39,750. 39,750 plus 15,000 plus 116,755 should give me 171,505, which means at a glance, we can see what the balance sheet looks like. Any question now? Any question? What I'll do is that since we've come to the head, I'll give access to anybody to unmute directly so that you can make one or two contribution questions and we'll close it out. Over to you guys. Any question, any contribution? Adewale Babatunde, over to you.
Good evening, sir.
Yeah, good evening.
For exam's sake, that our goodwill part, since it is written in the additional information that goodwill should be totally written off. Is it?
Your network is poor. Is it what?
I said, is it necessary for us to show the workings, or should we just, or can we just ignore? Since it is written in the additional information that goodwill should be totally written off.
How do you not know what to be written off if you don't do the working to know what is even the goodwill? How do you not know that it's 1 million you should write off if you don't determine what your goodwill is? And two, if tomorrow they now tell you it's 80% of it that should be written off, what then do you do? If you don't know the amount of something, how do you write it off? When I don't even know the amount, how do I write it off? Which means there's no shortcut. You must do the needful at all points in time. Any other contribution? Any question? Any other contribution? Before we call it a day. Silence connotes full understanding or otherwise. Okay. In the absence of no other question, both in the chat, raise your hand or otherwise, we'll call it a night. Thank you very much, and God bless you all.